My name is Simon Brown. This evening, Know Your Derivatives. We're going to be looking at shorting and hedging and as two particular derivative strategies or methodologies. I'm also going to bring in some reversal patterns. I thought let's get some practical stuff in as well. And obviously, reversal patterns work from for shorts, but for longs as well. And we'll delve into those. What's important here is I get my mouse in the right place. And there we go. You can lose more money than you start with. I kick this off every presentation. I know it's a little bit boring and the like, but truthfully, it matters. It's true. It is real. And it's important that people are cognizant of the risks inherent with trading and being a trader. So let's look particularly at shorting, and I'm touching on it for two reasons. One, because a lot of folks just don't understand the concept behind it, but also two, because it's actually, I mean, when I traded equity, I at some point just stopped shorting. I was just like, you know what, thanks, but no thanks. And when I look at my lazy trading system, which was very lazy, a couple of moving averages, weekly chart, trading indices, in fact, more often than indices, trading ETFs, and ungeared, I didn't do short trades, and I'll come to why in particular I was adverse to them, I suppose. But shorting is essentially making money on the downside. We understand how we make money on the upside. You buy something, it goes up, you sell it, you make a profit. Shorting is when you sell what you don't own, and then you buy it back at a lower price. So for example, you sell a share at 10 Rand, it falls to 9 Rand, and you buy it back at that 9 Rand level. You sold at 10, you bought it back at 9, that difference, in this case, 1 Rand, that is going to be your profit. So the distinction is you start by selling, as opposed to the usual process where you start by buying. You log into the Think Market system, you have no positions, you think something's going to be moving lower, so you start by selling it, and you click the sell button. That then gives you a negative position. So it will reflect that you are short, you have a negative position in the space. And that's exactly what you're looking at when you are shorting. You are, in essence, betting on a falling market or a falling equity or commodity or whatever it might be in that case. So it's that making money as things are going down as distinct from going up. And it is one of the benefits of derivatives. Most shorting is going to happen in a derivative environment rather than in a clean equity. You sign up for a normal sort of investment account, you can buy shares, but you can't go short of those shares. You're going to need a derivative structure for that shorting to facilitate proper shorting, be it a CFD, be it a futures. You can even use options, but options are a whole different kettle of fish, so we'll leave them parked on the side for now. But it is a important arsenal in a trader for a trader, and we have had range bound markets up until early March this year. In the US, mostly shorting was a no-brainer, sorry, no game, because simply if you were trying it, you were going to be losing money. But here's why I say to be cautious with some shorting, and that's because falling markets are incredibly volatile. They fall fast. They absolutely fall fast, and they bounce harder. And that then stops you, and then they continue on their falling process. So what happens is you get the signal, you jump in, but the old cliche is bull markets take the stairs, bear markets jump out the window. And the problem with that is that you get it right, it collapses, everything's lovely, it bounces, it stops you out, and then it starts falling again, and it leaves you, well, now what? And that's certainly a trend. And I mean, it's something, as I said, which made me say, hang on a bit. And some of my systems, I don't want to actually. When I'm doing index futures trading at the moment, trading the SA40s or 40, I'll take longs or shorts. That's not a problem. And I'm doing it in such a short time frame that certainly there is heightened volatility, but it's fine. It's manageable. But on those longer, and if you look at even just the collapse in March, I mean, it happened immensely quickly. It started to roll, and then it collapsed. And truthfully, when it then sort of picked up, what lows were around 23rd of March, when it started to bounce again, my view was, is this what we call the proverbial dead cat, where it then just collapses again, or does it carry on rising? We now know the answer. It carried on rising. We're 3 months and change later, and markets are still heading higher. So we did get that answer, but it took some time. Another point with shorting, and where a lot of folks make fairly fundamental mistake, which is they look at something and they think it's overpriced. They think it's too expensive. Capitec was a favorite for years. Tesla at the moment in the US. Everyone looks at Tesla. Now, there's two Tesla types, right? You're either in that trade and you're loving it and this is the best thing ever, or you're not and you're thinking, no, man, this is crazy. This is bubble territory. I'm going to short it. This is absolutely crazy. Yes, but no. I mean, I remember there was a short squeeze. I can't remember if it was, I think it was early this year. I think we're going back to around February. Short squeeze in Tesla, and it bunched up to around $800. And my argument was, hang on, guys, this is a short squeeze. Be careful here. And it did come back a bit. It came back maybe into the 500s. And then it went roaring off again to 1400. That short squeeze is critically important. Remember that if you are short a position, in order to exit it, you need to buy it. So what happens is when a large collective is short a commodity, an index, a stock, whatever the case may be, and it then starts to rise, that action of the shorts getting out actually pushes it harder and faster. And if there's enough of you short and you're all scrambling for that exit, that in itself actually makes the bounce even more marked and makes that move higher, which is what we saw in Tesla, that initial run to 800. The other issue with shorting is that truthfully, you can, if you buy a share and it goes to zero, you lose 100%. Even if you geared 10 times, you lose 1,000%. If you held it the whole way down, you wouldn't. But let's pretend in a fantasy world you do. Fortunately, in a short, well, sky's the limit. There was a time, it was Porsche. Porsche and VW were having, threatening to take over each other and the like. And what happened was there was a massive short squeeze. And at one point, and I think it was VW looking to take Porsche. Porsche was like the most valuable company in the world because there'd been such significant short positions in Porsche that when the news came that VW was perhaps going to buy them, that spiked the share. The shorts are all scrambling for the exit, and that just sent the share absolutely careering to the moon. And as that's happening, the shorts are bailing faster and faster. And as they're bailing, they're pushing it higher. Now, it works in the inverse, right? There's a whole lot of people who long a share. And bad news comes out. Fraud, Wirecard in the last couple of weeks. And suddenly everyone's heading for the exit, and that pushes it down. But in the shorts, remember, in the downside, 100% down, the stock's at zero. In the short side, 100%. In the case of Tesla, 100% up, and the thing was only at $400 and carried on going. Now it's at 1,400. So don't look at the valuations and say it's just too rich. Stocks can do crazy things and for way longer than you can ever imagine. A share can carry on going. Tesla at 1,400, most valuable motor car manufacturer in the world. Does that make sense in 2020? No. They're producing 500,000 cars a year. Toyota's producing 11 million cars a year, fully 22 times the number of cars. Now, is Tesla, or more directly, is electric vehicles the future of cars? Of course. In 100 years' time, people are going to look at the combustion engine and say, hang on, you drove down the street with thousands of little explosions happening in front of you? That's madness, and you were killing the planet, and that's completely silly. But in 2020, this is still a combustion engine market, and EVs are the future, but that's a long-term future. It's not a 5-year or 10-year decade future. It's a long, long time away. So falling markets are volatile because they fall so fast. They bounce. They stop you out. Don't try and tell a stock that it's too expensive. You need to go back crazy. I'm going to be shorting it. I've seen more accounts wiped out because people said a share is overvalued. It's ridiculous. Sure, it's ridiculous, but it doesn't mean it can't carry on going to more ridiculous and more and more and more and more. It can go absolutely insane. The market doesn't care for your views. If you're going to be shorting, use established charting patterns. Head and shoulders. I keep coming back to head and shoulders because it's the most reliable pattern out there. There was a great tweet which I just retweeted, and I know that I promised you folks a list of Twitter people to follow, and I'll come to that at the end of the presentation. Classic reversal patterns. Don't just wait for a slight little roll. I remember about 3 weeks ago, we had 2 red days in a row, big red days in the US locally, and my first thought was, chatting with a friend of mine, said to me, are we rolling over? No, we weren't. And there was nothing there except 2 red days. 2 red days do not make a bear market, not by any stretch of imagination. The key point is that there's nothing wrong with saying, you know what, I won't touch the short side. I'm a long-only trader. And as a novice and as a newbie, certainly long-onlys is not a bad place to be. And in this market, there's money to be made on the long side. I mean, it's weird. We're in a pandemic. It's crazy out there. There is money to be made on the long side. So we can just go long and be comfortable with that. But let's look at some of those reversal patterns. I'm a trend trader, so I like to get trends. But one of the first, key point of being a trend trader is that if you're constantly you take a stock, Tesla, right? What's the trade been on Tesla? For the last 5 years, the trade has been buy it, and it goes higher. And at some point, that will no longer be true. I have no idea if it's today, this week, it might not be for another decade. At some point, that will no longer be true. And what I've always spent a lot of time digging around is what do those reversal patterns look like? Because as a trend trader, I'll go long and get stopped, and I'll be back in with another signal and then stopped, etc. At what point do you say, hang on, this trend is no longer up, this trend's now down, and I need to change my thinking around how that trend is working? And there are a couple of them. Kangaroo tails. Now, all of these are obviously applicable for going long or for going short. The trend reversal from a downward trend to an upward, or a reversal from an upward trend to down. Kangaroo tails are deeply rare. And that example I've got on the screen there is not the best in the world, but I'm coming to one in a moment, which is an epic one. And in essence, in this case, you can see almost a blow-off top. You've got a candle up there which went up to the highest point that we had seen at that particular period, but it couldn't hold it, and it was pushed back down. And it closed down towards the bottom, and it left a big wick up there, which is that kangaroo tail. And the next day, if you're trading below the low of it, so there was your low of that wick of that previous day's candle, there would have been your entry zone somewhere around there. Now, it opened, it actually closed the day green. That's fine. You want to enter below the previous day's low. Now, I'm talking daily, but of course you could do this in a weekly chart. And truthfully, you're going to get much more reliable reversal patterns in a weekly chart. If you read Alexander Elder, he talks about the triple chart method, where he will start in a weekly chart, and that will give him his big picture. And you've seen a kangaroo tail which says, hang on a moment here, things are ugly, this trend is now reversed, and therefore I'm only looking for short trades. And that's a great way to initially filter. So your weekly chart tells you, as a trend-based trader, what's the big picture here? And therefore, what direction am I most interested in taking positions? And then from there, you drop down to the daily chart. And now you've seen this in a weekly chart. You wait for a daily confirmation, whatever that might be. And then you enter into the trade. And the third chart would perhaps be an intraday. Wait for that weakness intraday and do that. You stop on something like this, you'd put it halfway up your candle, so up your wick, so your stop loss would be somewhere there. And then as you start moving down and as it starts to collapse, don't be too aggressive with moving your stop. As always, give it some space. As it starts to collapse, you can ratchet that stop up, and then eventually at some point you'll get stopped up, or perhaps you'll take a profit. This doesn't have a target. This isn't saying, here's your target or something like that. These are rare. You know, the beauty of a rare signal is, it makes it more reliable. The rarer a signal, and don't go find a signal that happens once every 50 years or something, but those sort of signals that are less frequent, those are the ones that are typically more reliable. And in the case of kangaroo tails, they work on equities, they work on indices, they'll work commodities, they'll work currencies, they'll work any time frame. The point is when you just keep on looking out for them. I mean, I've been, watching kangaroo tails now for 15 years maybe. So I see it, and it's immediately, that just tells me something. That just says, hang on, it's a kangaroo tail lurking there. There's something brewing, something is changing in this particular space. Engulfing candles, I spent ages trading these in a 15-minute chart. They are wonderful. You can obviously use them for long or for short. Typically what you would do, this is a bullish engulfing, and what you've had a series of red candles, i.e. coming down, coming down, coming down, and then you get a green candle, but more importantly, the body of the green literally engulfs the body of the red candle. In your next candle, assuming you're higher, you enter the trade. And obviously, for a reversal pattern, you've had a series of green, for bearish, you've had a series of green candles, and then suddenly you get a red candle. Now remember how a candle works. Let's look at this red candle. What it says is it closed below the open. So that top line there, the top of the body will be where it opened, and the bottom of the body will be where it closed, and then the wicks are the high and the low of the day. And what this says is it opened higher. I mean, think around the psychology of it. So we've been having green candles, green candles, green candles, and then suddenly We open higher, which is bullish, says everything's in biz. We run higher, and then the market can't hang on. And we actually close below the previous day's open. And that is bearish. It's the psychology of what's happening. When I'm trading engulfing candles, I always want, if I'm looking for a bearish, I want 3 greens and then an engulfing red. Or if I'm looking for a bullish, I want 3 reds and then an engulfing green. And then I jump in. Where do I put my stop? Typically, I'll put it halfway through the candle that's been engulfed. So I'll initially put it halfway through the green one there for the bearish, or halfway through the red one there for the bullish. And then as soon as I'm in, now I've got my stop, and then I'll move the stop accordingly. But it's a case of waiting. And I'm going to come back to it. Trading at its core is patience. Trading at its core is waiting. The discipline to wait. To sit in your hands and say, that looks like it's an engulfing candle. But until it is, it's not. And if you wait and halfway through a candle, you think, this is it, it's going to happen, I must get in or I'm going to lose out. You're going to get cleaned. Wait for the confirmations. Trading is about that patience. I suppose it's akin to fishing. I haven't fished since I was an absolute kid, a teenager in northern KZN in the 80s. But it's that sort of sense of lots of waiting, lots of patience, critically important. And here is just a ton of them. So I actually pulled this out for an engulfing candle. Now, truthfully, it's not clean because there's another one in between. But what I had was a series of bullish candles. And then we had a kangaroo tail. And then we had an engulfing. I think this is cable, sterling dollar, pound sterling dollar. And then we just had a epic collapse of massive magnitude. In truth, that red candle there, the second red, if you take that as a kangaroo tail, that would then have been a case of, well, great, enter the short already, you would have entered the short around that point. If you wanted to wait, you would have entered the short around that point. And this is a trend so this has been trending up, not strongly trending up, but it had been trending up, and then it just collapsed. I mean, this is hundreds of pips that this threw out. And the key point was that waiting. Just that waiting and waiting and waiting. And this happened, these are all daily charts I'm showing you, but you'll note I've taken the time frames off because the time frames don't matter at all. And what we quickly got is a sense of that collapse. And it happened in one heck of a hurry. If we go back to here, that collapse was fairly slow and muted. Although interestingly, you will see, and I see your question there from Tabang, I'll come to you in a sec around gaps. You would notice a couple of gaps here. There was a gap there, and there was a gap there. And gaps get closed. Gaps get closed. Tabang, you're right. I mean, gaps in the Forex market, will gaps always be closed? I'm a believer that gaps always get closed. The problem is how long. And I've seen gaps that have literally taken years and years to close. So if you want to trade gaps, either you look at them as breakaway gaps, where a market gap's higher and then just carries on growing. Will it come back to close it? More times than not, but in the immediate, it's running and you want to be on that bus. The other one is to trade a gap close. When a market opens at a gap and then it starts to come back into it, expect it to close that gap. And so what you could have done at this point on this blue candle here, you could have said, hey, we're coming back to close that gap. So it opened down there, rallied up to that point, and then you take the short. Not much there to play with, but certainly there was some space there. I spent a couple of years when I was at Standard Bank, when I was beta testing a product, and I was trading gaps, left, right, and center, taking some gap trades. And then my favorite is an island reversal. The problem with an island reversal is, man, these things are the rarest ever. And what you've essentially got is the stock moved along, whatever it is, index, commodity, something. Tabang, there's another gap. It closed. Anyway, tiny little one there. I mean, it's tiny. It's probably not tradable. You're running along, stocks moving, suddenly gaps higher, and then suddenly gaps lower. And what you basically have is a giant big gap there, and that is a failure of a breakaway. That was attempting to break away, and it has fundamentally failed. It's called an island reversal. Basically, the day that you see it, you enter the next candle, so you would have entered on that red one there, and you would have taken yourself a lovely short. However, I want to show you what sometimes happens on these as well. Island reversals are, of all the chart patterns that I keep an eye out for, This, by a long, long way, is the rarest of all of those that are out there. But it is immensely powerful, except when it fails. So this actually happens to be a Sasol chart. You see the gap down there, went off, traded around here, and look how long it played out over. This is, what, 5th of March. First COVID case in South Africa, bad news out of Sasol, and all the way to June. And then suddenly, 7th of June, which is a month ago, bang, you've now got that island reversal. You've got to give them time. And as I said, I just retweeted something on Twitter, and the illustration that the guy was using was that, so he likes breakouts, and it took weeks and weeks and weeks for that breakout to get to its target. And we get impatient. We get impatient with the waiting. We get impatient with the target. So here was Sasol, beautiful island reversal, seemingly setting off to the races, except that happened. And it all came collapsing back down. Now that gap, if I remember at the top here, was about 160 or so. Tabang, back to your point, a number of folks were saying to me, will that giant gap there from Sasol, will it close? Well, the answer is yes, it did. Fortunately, it closed in an island reversal, and then the island reversal promptly failed on you. And that's the point of trading. I would tell you that the best chart pattern is head and shoulders, without a shadow of a doubt. Problem, so it doesn't always work. Head and shoulders is about 75% accurate, which means, put it the other way, around a quarter to 30% of the time, it fails. And we've got to always be prepared for the fact that there are no certainties in anything, and particularly not in the trading and charting environment. So it looked like a great, and I remember I saw this. I mean, I remember chatting with someone about it and saying, yo, island reversal and Sasol, this is going to be a great trade for the longs. And it just collapsed back down and is now muddling along and going nowhere. Year end is June, waiting for results. Chatting with Keith McLaughlin, who's not a trader by any sense, he's like, surely there's going to be no good news in the results. There's no surprise to the upside in the results. There's only surprise to the downside. Maybe looking for a sell signal in the charts might be worth a shot there, because the results are either going to be neutral or negative. The likelihood of them being positive is, I think, and Keith's idea, I concur with him, I think is absolutely tiny. Highly, highly, highly unlikely. So it's about that being patient. It's about waiting for that confirmation. It's about don't enter early. Because, the number of times you enter early and then it's like suddenly you realize, so you were convinced this was going to be an engulfing or a kangaroo or whatever it was. You enter early and then it doesn't happen. And you're left like, oh dear, now you're in a trade that you actually shouldn't be. You're in a trade that didn't give you a signal. You thought it would give you a signal, but it didn't. And then once you're in the trade, give it time to play out. And some of these play out slowly. I mean, this is an example. This, take that picture there. It was a failed trade, but the example's there, fine. This is 3 months. 3 months for that island reversal to play out. 3 months for that gap to close. So if you're in that trade, don't expect immediate and gratification. It's going to be a case of you get into the trade, let it do its work. Give it that time to happen. If you're preempting, don't do it. You're going to get hurt if you're looking to preempt trades. Wait for that confirmation. Wait for it to happen. And I take it a step further. I always do my two-step entry process. So my first step is I get the confirmation. That's all well and good. I'll wait for a second. So I call it trigger and confirm. And for me, the confirm is easy. So there was your trigger, right? That blue candle there says to me, boom, we've got an island reversal, we've got the gap. That blue one is my trigger. My confirmation is I want the next candle to be, this is a bullish one, I want the next candle to be up. So it doesn't have to be a green candle. That wasn't a green candle. No, open close. In fact, that actually wouldn't have confirmed. So this trade would have failed. I need to get my glasses tested. So I would have said, that was my trigger, the blue candle. Cool, it's green, everything's lacquer. I want to enter at a close that's higher. And what I do is I wait for the end of the day. So as that red candle is forming, I'm waiting, and at points in the day it was up and nice, it opened nicely, everything's looking good, but I'm saying I want a confirmed close. Trigger, and confirm. If I'm in a trade, I want that first day of the trade to be a positive day. So I would have waited for the close, which meant I wouldn't have entered, which meant I would have missed all that pain. And the point with that two-step process is that it gets you into less trades, because what I would have done here on that second day with the red candle, I would have said it hasn't confirmed, but you know what? It is still valid. It's still a valid signal. So if on the following, or 3 days, or 4 days, or even 5 days later, I get a close above that trigger candle, then I'm into the trade. Until such time as my trigger fails, and that giant red candle would have been my failed trigger. What does that mean? It means I get into less trades. And every trade I don't get into is a loser. So actually what it does is it gives me less losing trades. And there isn't a trader in the world who doesn't want some less losing trades. In this case here, there was your trigger. Your confirmation, in other words, closing lower, was actually going to be the second red candle. That would have been your confirmation, and then you were off to the races. So that one did work. Here, there's your confirmation. As I said, if you were waiting, you had so many confirmations on this particular trade. On this one here, there was your kangaroo, and again, there was your confirmation. It closed off the lows of the day, and it closed above where it opened, but it closed lower than the day before. So it gives me that confirmation in a sense. So I'm always doing trigger, confirmation. And when the confirmation fails, if the trade's still live, I'll wait. But the important point is, every time I get a trigger and I don't get a confirmation, it means there's a trade I didn't enter that would have lost me money. Arthur, problem with trading is I have to exceed my fees first. I can't trade small differences like the pros do. I have about a 1% penalty up front. Arthur, that's a great point. So, so think markets right now on ZAR CFDs, no minimum fee. Because that's the point. You rock up with, I don't know, whatever it is, a couple of $1,000, and there's a minimum fee of of 100 or 150 or something like that. And you've got to make a truckload just to pay the fees. So typically I say to folks, you need a minimum of 20, but ideally 50 or 100,000. Think markets on their CFDs, local, no minimums, and that is a giant biggie. That means you can drop in a small trade and it's going to be that percentage. It's not going to have those minimums. So Arthur, you are right and well spotted. As a newbie, you want to trade small because you're learning, but then the fees absolutely kill you. In Jabula, Island is the 17th. Does it invalidate the signal? Are we back to this one here? Yeah, I mean, as soon as that giant red candle came down, it invalidated because we no longer had that particular island sitting there. So that absolutely invalidated it. Question coming. Oh, okay. I get the question. How do I, what's my confirmation? So my trigger is going to be the island reversal or an engulfing or a kangaroo, whatever the case may be. My confirmation is just that I will enter on a candle that's closed in that direction. So if I'm looking for a long trade, I want a higher close for my trigger. That blue one there was my trigger. I need a close higher than that trigger. Didn't get it, never happened. In fact, we've never closed higher than that level. And now the trade has failed. On this one here, the green candle was my trigger, my confirmation, and I'm looking for a short, and I want to close below the close of that day. In fact, it would have been the first red. That was my close on the first day down, and then I'm off to the races. So it just keeps me out of trades, and it keeps me out of losing trades, which are great trades to be kept out of. But I go back to, trading is about patience. Trading is about waiting. Trading is about cautiously, when you're watching the market the whole time. If you're trading daily charts, you're checking it daily. If you're trading intraday, you're there all the time. Whatever your time frame might be, your key point is that you are waiting. You are waiting for the setup to confirm. I know when I was starting to trade and I was doing patterns and the like, what hurt me the most was that jumping in, that being too quick, that not waiting for confirmation. And yeah, I'll trade a 15-minute candle, and at minute 12, I would say, surely, there's only 3 minutes to go. Surely it's going to confirm. You jump in, and as sure as Murphy is watching, it doesn't confirm. And now you're in a trade that you shouldn't be. So the right response is to get the heck out of the trade. Now you've crossed spreads, you've incurred costs, and it just starts to hurt. So let's touch on some hedging. Folks, you got questions, you're welcome to drop them in. I've got my questions on my other screen, so I'm taking them as we go along, and certainly we have some time. So hedging, as per Investopedia, is the risk management strategy employed to offset losses in investments by taking an opposite position in a related asset. The operative word there is really around investments. This is a insurance policy in a sense for investments more than anything else. The reduction in risk provided by hedging typically results in a reduction in potential profits. Yes, because you've basically taken an insurance policy and it typically involves derivatives. And again, because you're going to be wanting to go short. So you own 100 Sasol shares and you think, yeah, I'm not so sure about this. So what you do is you take a short position in Sasol. You own 100 Sasol shares, you've got a short position, so now you've got no exposure, or you've got reduced exposure. You own 100 Sasol shares, you've shorted 50. Means if Sasol runs higher, you're losing on the short, but you're making on the equity. And if Sasol falls, you're losing on the Sasol, but you're making money on the short. So let's delve into that. So two ways of doing hedges, either full or partial, and then you can do portfolio or stock. Full hedges where you've got 100 Sasol shares and you short 100 Sasol CFDs. And basically, you've locked in the Sasol price. You said, if Sasol falls, I'll lose money on the shares, but I'll make it on the CFDs. If Sasol runs, I'll make money on the shares, but I'll lose money on the CFDs. You've locked in that price. The question is why? As a long-term investor, why would you care about short-term price moves? Yeah, and if you're a trader, then you're just trading, long or short. You're waiting for triggers, you're waiting for confirmations, you're waiting for signals. So hedging to me has always been something I'm not massively thrilled with. You can look at a partial hedge, and I'm talking particular stocks here. I'll come to portfolios in a moment. You could do a partial. So instead of doing you got 100 Sasols and you short 100 Sasols, you got 100 Sasols and you short 50 or 30. So you've actually got a strategy to try and protect. And that becomes almost more like an insurance policy. So if Sasol falls, you'll lose some money, but you'll make some of it back on your hedge position. So it won't be so calamitous. The problem is that your CFDs are linear profiles. And when I'm doing that sort of insurance product, I much prefer a non-linear. And therefore, options are often a better product, but options are few and scarce on our market. If you're in the US, there's a wide option market. To a degree in the UK, not in South Africa. You can have a look at a portfolio hedge. And a portfolio hedge says, well, I've got X Rand value in my long-term investment portfolio, and you could use something such as the ZAR 40 and take a position in that. So you've, say, got 100,000 of a portfolio, and you take a small hedge down on the ZAR 40. I've done it with a warrant. I've got a put warrant on the top 40, which I'm down about 50% on, but that's the point of insurance, eh? I mean, the point of insurance is that you're paying to protect against an event, and if that event doesn't happen, well, sorry for you. I mean, you've paid the monies. The event didn't happen. The insurer gets to keep the money. And in this case, it would be your losses on that particular position. So portfolio hedges, but again, if you are a long-term investor, I mean, you can certainly do it, but I'm not convinced by the whys you want to be hedging a long-term portfolio. Maybe if you're in retirement, maybe if you're living off it, maybe if it's an income portfolio, then things get a little more different. But otherwise, as a long-term investor, I'm not convinced. There are, however, exceptions. A currency hedge. Now, we live and earn in ZAR. And let's say you're long platinum, but you're using a platinum ETF. So you're long platinum, but you've bought it in rands. Platinum goes up 10%. But the ZAR strengthens 10%. It goes from 17 to 15.30. You make zero. You were right about the platinum, but the rand hurt you. Basically, the rand took your profits. And this happens often in gold. I've seen it more than a few times where gold runs, rand strengthens, and the rand gold price doesn't move. So your first option is buy a US dollar platinum ETF offshore in your US account, and then problem solved. Second option, say you've got 30,000 in that platinum ETF. Let's say ZAR's at 15. So you've actually got $2,000 exposure. You've got $2,000 exposure. Use FX to hedge that position. So now you've removed the currency from the equation. basically go and sell the USD ZAR, $2,000 worth, and any currency move in the ETF will be offset by the FX position. So what it does mean, so if platinum moves, you'll make money, and if the rand moves, you'll either make or lose. But if you make money, you'll lose it on the FX, and if you lose money, you'll make it on the FX. What you're effectively doing is removing the currency from the equation, and that's quite cunning. And I quite like this as a strategy. If you're trading sort of in ZAR, but you're trading US product. And the other thing with Think Markets, for example, you can in your ZAR account, you could buy Apple. And Apple's obviously a US dollar stock. So now you've got that currency exposure. And they trade you into that currency at spot, and they don't charge you any fees. But you put 30,000 ZAR into Apple, but let's assume the ZAR, and I did ZAR at 15 just because it makes the math easier. Your dollar exposure is $2,000. So use FX to sell 2,000 of the USD ZAR, and that'll then mean that you won't get impacted by currency moves. You'll only get impacted by moves in the Apple share price. So that is quite significant and something I think well worth considering. The easy solution, of course, as I mentioned here, is get a USD account, physically move money offshore, fund a USD account, and you're off to the races, no problems whatsoever. And that solves your currency problem. But oftentimes, and we've seen very prolonged periods of currency strength. December 2001, we had 1360, and 3 or 4 years later, we were sub 6 Rand against the dollar. And if our markets did okay. In fact, our markets did very well up to a point, 2007. Initially, they were struggling. And the trick is that so much of our JSE is earning in foreign currencies. Now, it gets complicated, right? Because 10 cent is Chinese renminbi. What else we got? We got a bunch, who are in US dollar. The miners are all dollar denominated. A lot of our, ShopRite, for example, is currencies into the rest of the continent. MTN is their largest currency is actually the Nigerian naira. Then ZAR is their second largest market. But you can, you can start to see. Look, if you're going to see prolonged periods of ZAR strength, maybe I want to take the shine off. But I don't want to do a currency hedge on a portfolio. I would do a currency hedge on a particular trade. And what you're essentially doing here is you're building yourself a structured product. You're basically saying, well, I like gold, but I don't want to have the issue of the rand here, or I like platinum, or I like Apple, whatever the case is. I like it, but I don't like this issue of the rand here. So, how do I, what about that? Well, you hedge it out with a currency trade. And currency trades are, your spreads are tight, although they're going to be wider in the ZAR, but they're effective in that sense. Folks, I see some questions coming through. I'll take them in a moment. If you've got, certainly drop them in. So the homework, and it's the same homework every week. I know I'm boring, but I'm that sort of a teacher. Set aside every week for your learning. You're learning how to trade. You're attending webcasts such as this and others that we've got. Next week, we're looking at risk. Engage your family or your significant others as to the whens and the whys. Like, okay, guys, Wednesday, 6 o'clock. There's a Think Markets presentation. Please, can I take an hour, 40 minutes, usually around about 45 minutes, to do it? And when are you going to spend your time at the charts? Open a demo account and learn the platform. When you do your first trades with real money, it's going to be stressful enough. Don't also have that stress of the demo and of how to work the platform. Make sure you've set up your demo account. Start working with charts. Start looking at trend lines, looking at patterns, indicators, oscillators, and the like, all of those sort of things. Start looking at trading systems. Start placing stop losses. I've said already, find yourself 100 charts and go place 100 stop losses and then check them every day, every week, every month. How were they? I positioned it here. My logic was this. It did work. It didn't work. They're not going to be perfect. But start drawing those trend lines. Start looking at indicators and oscillators. Take these reversal patterns. Start looking for them out in the real world. See where you can find them. You can go back in the time and charts. Look where they were, how they worked. Look at that two-step process of trigger, confirmation. Does it work? And start saving. Think trader on the local CFD is no minimum, so it's quite easy. But at some point, you want to get a bit of cash behind you in the trading space, and always be learning. So when I did the presentation, was it a couple of weeks ago? I said, careful who you follow on Twitter. There are a lot of trolls on Twitter, to be honest. So I'm putting together a list of great traders, chartists on the Twitters. And unfortunately, that is the URL, and it is absolutely the ugliest URL in the world. So go find me on Twitter, Simon PB, and then go to my profile, go to my lists, and find the one that says charts. And then you can subscribe to the list, or you can just pick out who you particularly want. It's a dynamic list. I'm adding to it as we go along. I'm looking for local and also for some global traders. And I don't particularly mind what they trade. I just mind that they're proper traders rather than fools. And if you've got peeps who you think should be on that list, send them to me. Perfectly okay to ignore shorting. Find yourself an edge. And that edge might be, I don't do shorts. Maybe you want to be a reversal trader, then go have a look at those reversal patterns. I put them into this evening's presentation more than anything as examples, as illustration. But reversal patterns they can be quite powerful. Head and shoulders, a question coming through. Is head and shoulders a good reversal pattern? Yeah. Head and shoulders is either ways. I mean, it can be an inverse head and shoulders, which is bullish, or it can be a classic head and shoulders, which is bearish. The thing with your head and shoulders is you want a proper formation. If you're having to turn your screen at 36 degrees and squint weirdly at it to see the head and shoulders, it's not real. Don't manufacture trades. Don't manufacture an edge. Don't manufacture what looks like a signal. If it's there, it'll be so blatantly obvious it'll bite your nose off. This one here, where's it? That one there. There are so many signals there that are telling you to short it. It is just blatantly obvious. The question coming, did I trade it? No, I didn't. I didn't see it at all. I picked it up. I'm going to say Johnny come lately. No, I picked it up after the fact, way after the fact. But very important is find yourself an edge. And you can have a couple of edges. So I trade trends, but in the mornings now, I'm trying to find out where the market is, and I'm jumping on it. And you can have 2 or 3 different strategies / systems / edges that you trade. That's fine, but be resolute about them. And then hedging. Be asking why. If you're trying to hedge out a currency risk, I got that 100%. But otherwise not. Question coming through: could you use a currency for a holiday? You absolutely could. So let's say the rand suddenly strengthened to 14.50, and you're going to on holiday to Europe in December. Yeah, okay, so I'm just making stuff up here. The rand at 14.50, and ain't no one going to Europe this year. But let's pretend it's 2019, and you look at 14.50 in the rand, and you think, I like that price. I hope it's still there when I go on holiday in 6 months. Well, hedge it. In other words, lock in that price. Use an FX position, lock it in, and basically, if the rand moves to 17.50, you'll make 3 rand a dollar, which will help you pay for the currency. And if the rand goes to 11.50, you'll lose 3 rand a dollar. Basically, you've locked in that 14.50. So absolutely, sorry, I deleted the question before I saw who it was. You can use this for, I know importers who use it, because they buy something, they got to pay a deposit. In fact, they pay freight on board. So as soon as it hits the boat, they got to pay for it. And it takes 3 weeks to get here. Man, that stuff can, so what they do is they hedge it. From Anonymous, good trading platform for beginners traders. So, I mean, as I said, the think markets with no minimums on local CFDs is a giant issue. Otherwise, your minimums are typically, 100 rand and running upwards. I actually stumbled across a platform over the weekend that's got a 350 rand minimum. They're not even cheap. The CFDs are 0.4, and then the 350 rand minimum. Beauty of think markets is you can put $1,000 in, and you're gonna pay your 0.2. There's no minimums, and that's a big deal. That is absolutely a big deal. Sorry, running 2 screens, folks. We've got a minute and a bit left. If you've got some more questions, 2 more of this series coming up. It's been a while. It's just started back in May. Next week, Wednesday. 6 o'clock, same place, everything, Trading 101. We're looking at managing risk. I'm going to be looking at stop losses, the what, the where's, the how's, some ideas around stop losses. I'm going to be looking at 2% rules for individual trades. I'm going to be looking at overall portfolio risk. And then at the end of the month, 29 July, Think Markets Care will be we're going through their trading research ideas and the like. Jacques, absolute pleasure. Sorry, I'm seeing some questions coming through in the chat. Let me find those and let me move that down. Mark, absolute pleasure. Okay. Why don't I trade? Sorry, I didn't. I did the typo there. Why don't I trade stocks? I have. I have been trading. I started trading in the mid-90s. I started with stocks, moved to warrants, traded those, and then started trading indices. And there were two reasons I moved away from stocks. One, so I moved to Standard Bank, and there were compliance issues, and I was in the media, and there were all those sort of challenges and the like. But also, I'd been struggling with stocks in terms of you get a lot right, and then there's suddenly a trade that, single event risk. And that single event risk is a bad trading update or a bad set of results or a takeover announcement. And I didn't get caught with a lot of them, and none of them completely stole they certainly stole my lunch, but they left me with a little bit of a snack maybe for tea. So they weren't totally ruinous, but it was just like, how do you manage the single event risk? And I was looking at different ways, and I forget who I was chatting to. And he said to me, well, easy, don't trade them. And I was like, well, then what do you trade? And he's like, trade indices, just trade indices. So I'm an index trader. I trade indices. South African Aussies are 40 and DAX. All the other videos, justoneUp.com/thinkmarkets. This video will be up there later this evening. If everything's been working, we've actually been broadcasting live simultaneously to YouTube, but I've got enough screens, so I haven't been able to test it. I read one, 15 years. Sure. Actually, I think you're right. Yeah, absolutely. Hundreds. And then, of course, contact details for Think Markets. Their support lines 24/5, in other words, Monday to Fridays. Give them a shout. There's their website. As always, legal disclaimers. Ladies and gents, we will park that there. I've hit my time. Questions have disappeared. Everyone, really appreciate your time this Wednesday evening. Stay safe, wash your hands, wear your mask. Things are getting crazy out there. COVID is peaking. This is not a fun place right now. Everyone, cheers all. Thanks for your time.